Okay, that was more like 7 or 8 minutes. But sorry about that. I really want to have the chat, and the chat should work. I'm gonna check it. I lost the chat. That means I lost your attendance. That's pretty bad. So yeah, say hi again. Oh well. I'll wait for people to come in. I sent the link, but I shouldn't have to send a link. You can find it in the playlist usually, unless I forget to add it to the playlist. Should be able to find the video. People are coming in now. Oh, it looks like, no, that's today. That's now. Yeah, just say hi again. Sorry. Too many things for me. I have to make a checklist and follow the checklist every time so I don't miss anything. I don't mind doing this live stream stuff. It's just different. So it's a different skill set. I have to get used to it. And I have to keep talking or else it's going to buffer. Gotta keep talking. I can't sing either. I can't sing any songs. That's going to get me a copyright strike. I'm just waiting for people to come in. And having said all that, you know, it is a good skill to develop to be able to work on this. Just checking the other video that we did really lose the chat. Did lose it, looks like. So annoying. Okay, so yeah, just let me know you're here. Only got 10 people back so far. See, and it looks blurry. Why is it blurry? Do I have to touch that screen? Shouldn't be blurry. Does it look blurry to you? No, it's my glasses. And it's a buffering thing. I don't know. Looks blurry. Anyway, I used to make edited videos, and those take forever, so I do prefer live streaming to edited videos. I'm too much of a perfectionist. Maybe if I make it bigger, it won't be blurry. That would probably solve it. There you go. Maybe that's better. I don't know. It still looks kind of blurry. Okay. Where are the people? There were 30 people watching. Now they're gone. That's a long break. So it won't take another break. This will be it. Hi again. Sorry for the interruption. Okay. So we left off. We talked about mixed cash flows. Any questions about mixed cash flows? No questions. So what we're going to do now, just a summary. In general, for finite number of mixed cash flows, you can use this formula here. So it's solving for the NPV and interpreting what you get for CF, or what you get for the NPV. The negative of that will be your investment, the amount you should invest. What if, however, so we've looked, we've used the NPV for solving a problem of actual NPV problems. We've used it for, and we've manipulated it so that we could use it for mixed cash flows. What if cash flows are not just mixed and finite, so that it's mixed and then just like a finite number, so it cuts off, it's a limited number, right? Just T cash flows. What if you have a problem where the cash flows are not finite but infinite? I'm going to teach you how to deal with that. And what if, because if they're infinite, are you really going to sit there entering values into CF keys for an infinite amount of time? No, right? That's not practical. So there's got to be a better way. What if cash flows are the same and not mixed? How can we take advantage of situations to simplify a problem when cash flows are infinite, and as long as they are the same cash flow, we can actually simplify formulas that we can use. Here's an example. You can purchase a British Consul bond. What's a bond? How do you guys explain to me what a bond is while we're still waiting for people to come back? Right, so a bond is a certificate that the holder of the bond loan money, okay? So it's a loan, it's a security where you have loan money, the holder has loaned money. And for the incentive to loan money, the bondholder is promised something, right? They make something for doing that. So this one actually pays $100 every year forever. It actually exists that you can loan an amount of money that pays you $100 a year forever, and it's known as a British Consul bond. If the yield to maturity is 5%, what is the fair price? What does yield to maturity mean? What does yield to maturity mean? Nope. The yield to maturity. So what we're going to do is we're going to yield to maturity. No, yield. What does yield to maturity mean? Nope. You haven't told me yet. Oh, Dowsett. Okay, so the expected return. It's the expected return. So this is like the return. And it's represented in this problem as the annual return. Okay, so this is the annual return. So this is actually, for our formula's sake, this is like an I. So what's going to happen is you're going to apply the formulas that we've learned, but to different problems, different types of security, different types of assets, right? And every time there's a different terminology used. Okay, to bonds, the return is known as a yield to maturity, but it's still going to go under the symbol I. It's not the internal rate of return, Carlos, but that's That's something else, but yes, it's a return. There's a return, okay? And it's so what we're going to do is we're going to think about this. We're going to say, well, we're investing some amount today. I'll leave the zero out, but okay, the present amount, and we're going to earn I on it to get $100 every year. This is the setup. This is the setup. So think about it like the principal amount stays in a pot, like it's a fund, and every year it's going to earn the 5% so that it can pay you the $100. Now, whatever the bank does with that money or the government does with that money depends, because bonds can be from government or corporation. I believe this is a government bond in Britain. They can do whatever they want with the money, but you have your money set aside in a fund, right? So they could make more than that with your money, but they promise to give you $100 every year, and this happens forever. So when you look at it this way, if you let the 5% be I, what should PV be? If these are multiplied, I can't seem, let me put a multiplication symbol here. That's not an X, it's multiplication. Right, so if you do this algebraically, it's a different formula. You've seen it before in your classes probably. We would solve it like this to find out that $100 forever at 5% is worth $2,000 today. Okay? So that's easy. Algebraically, you see that. And now this is going to give us a more general formula that we're going to use a lot in this class. But I want you to take a minute and think about how that happens. Does that make sense? How do you explain to someone that $100 forever is not an infinite amount of money? One way to explain it is you say time value of money. You say, well, over time, $100 is not worth as much. Every year it's worth a little less and less and less. So eventually what's happening, and this is the best explanation I know, is those amounts from the perspective of today are getting smaller and smaller and smaller and smaller. Eventually they become zero. So at some point you're just adding a bunch of zeros. So what it means is that before you're adding zeros, the total becomes 2,000. Okay? So people who are coming in, we have a good group of people. Make sure you say something in the chat so I can have my attendance, because I lost the chat of the last stream. Okay, so eventually you're adding zeros. Here's the formula, and I know it's so simple, but it says a lot, okay? So let's look at this carefully. It's there, Kelvin. The last stream is there. I saw it. It just, it's not showing up where you think it should show up. I put it in the playlist. It should be there, so don't worry. It didn't disappear. Okay, let me double check, but I'm pretty sure it's there. Give me a second, and I have to keep talking, or it's going to buffer and be even more blurry, and might turn off. So I'm just going to keep talking. I'm going to check in the playlist. No, check in my playlist. Make sure it's there. Yeah, it's actually at the very top. It is there. It's in the wrong order. Part 2s are going on top. No, it's weird. Anyway, oh, it's probably because I added it to the playlist after. See if I can rearrange them later. Okay. Yeah, it's there. Okay, let me get that. Let me show you the notes. Maybe I can take the calculator off now, okay? I'm going to take the calculator off for a little while. We don't need it. No, it's too big. Can't make it that big. There you go. All right, let me go back to what I was saying. So that's what I wrote. Everything's, most of the things that I write are in the notes already. Eventually you'll see it. Okay, any questions? Okay, so this is called, so I was saying, so this is called a perpetuity. And what are the conditions for a perpetuity? It is infinite cash flows, and they're all the same. Notice this number, this value, C1, it means that the first cash flow, the cash flow at the end of the first year is all that matters. And this, I'm going to say period because you can use the formula for any kind of period, years, months. But the point is, the first cash flow comes at the end of period 1 and it continues to be that same level, the same amount. So what I've done on the formula sheet is I've written or drawn the timelines for you because this formula can only be used with this timeline. If you have a different kind of timeline layout for your cash flows, you have to modify the formula or this is not the right formula for you, all right? So you have to remember those conditions. The first cash flow is 1 period from now, at the end of the period, in other words. Okay, next formula. This is also a perpetuity because these cash flows will go on forever, but they're not the same. In other words, okay, let me read it first and then I'll look at the timeline. ABC Incorporated just announced it plans to grow steadily and will pay stockholders $100 per year per share, starting next year, and then 2% more each year forever. It's another word for forever. Given a required rate of return of 5%, what is the fair price of a share of stock? Okay, so this is for a corporation, right? So the course you're taking is also known as corporate finance in other schools. Call it managerial finance, but it's also known as corporate finance. So really the focus is valuing firms that both borrow money through issuing bonds and also borrow money, raise capital. So they raise capital so that they can do things, right? Expand or grow. And they do that by borrowing money through bonds, issuing debt, or by taking on more partners. And the partners they take on are known as shareholders. Okay, so a company with shareholders can possibly exist forever because shares can be sold. They could also be passed down through inheritance from one generation to the next. So they can potentially, it's possible that a corporation is has more continuity, can last forever. So this is the thinking here. That theory, that understanding is played out in valuing the stock. So you're told that stockholders are getting $100 a year, and the company is expected to grow. So this is an indefinite growth. They set their growth at 2%, just about inflation, right? So they're going to grow at the rate of inflation, 2%, and that means that stockholders are going to see that return as well. So the first year they're going to get 100, but then the next year they're going to get $102. And then after that, you can't see that. I'm going to make that higher. Oops. Okay, I like $102. Now I'm not going to write them all out because what I really want is the pattern. I need the pattern. And I want to use the pattern to derive a formula. Okay, so let's review the conditions. The first cash flow is coming one period from now, and then the cash flows grow. And they grow forever. Okay, so those are the conditions. What's happening now? Well, these cash flows, if I was to discount them back to today, their first one is less than 100, right? Because of time value of money. The next one is less than 100, and 100 times 102, and so on. Okay, so they do erode. They do go down. However, if you go back and you look at the values for just 100, obviously because these cash flows are higher, the cash flows are eroding slower, and it's slowed exactly by this growth rate G. So we're going to modify our formula to include that without proving it beyond you trusting me, that this is the formula as long as the first cash flow is one period from now, growth is constant at G. Now, thinking about that, that's the assumption, and I'm telling you that, but in reality, why should it actually be exactly 2% all of the time? It's an assumption, right? And we use it to make this calculation. And one more assumption in this that we'll talk about in a second. Here is the formula. This is what I have on the formula sheet. The cash flows will be, in general, look like this, okay? So one year from today, the first cash flow, and the second year, the growth starts. So there's no G in here. Just here, G, G, forever. So now we ask the question again, how can you expect these cash flows not to explode? Why doesn't it become infinite? Why is this just going to be a single number? If I apply this formula, I actually calculate that the price is, or the value of this investment is 3,000. So the first question about the console bond was worth 2,000, but with growth, we get more, right? 3,333. But why isn't it infinity? Why isn't it infinite? Well, it's the same rationale that we used last class. It's not infinite because eventually we're just adding zeros, but it happens later on. We make it as much as, we get as much as 3,000 in return in present value dollars. So that is the fair price. That's the most anybody would be willing to pay for this deal. If they could get this deal for less, they'd do it because they'd see a profit. But that's the most they'd be willing to pay. So let's talk about I minus G. So notice, for this to work, for the formula to apply, and you should always do this when you punch this in your calculator, you should always simplify the bottom, right? You don't want to put 0.05 minus 0.02 in your calculator. Just subtract it here, and now you punch this in your calculator, 100 divided by. Notice there's no financial keys for this because it's pretty simple. It's just 100 divided by 0.03 and equals, and you get this answer. This only works, however, as long as I is bigger than G. If G is bigger than I, what's going to happen? Can anybody tell me? No, I did it wrong. I is bigger than G. I wrote it wrong. But if G is bigger than I, what happens? I'll make a note here. Nobody? So let's look at the timeline. This will help you. So if G is bigger than I, okay, so Ricardo said it gives you a negative answer. Correct? It gives you a negative answer, but you should never use the formula. First of all, you should never use the formula. If G is greater than I, do not apply the formula. It doesn't work. It gives you a negative, which means nothing. It's impossible to be negative. So it doesn't work. Okay? But if G is greater than I, what would be your answer for this problem? So let's say if G was 8%, what would be the answer? What would be the present value? It won't be negative because you can't use that formula. You have to use first principles. You'd have to make a timeline and figure this out. Does anybody know? So I'm trying to show you the formula, but I want you to understand what the formula does and what it doesn't do. In this case, you cannot use the formula, right? It can't be a negative, but if G was 8%, what would be the answer? Think out of the box. What would be the answer? So if the growth was outpacing interest indefinitely, this amount would explode, okay? PV would be infinite. Now, because if this actually existed, everybody would drop everything they're doing and invest in that. That would never exist. Okay, this couldn't exist, the price would be shot up. It'll be infinity. So it won't exist in markets. So you'll never, you wouldn't use the formula first of all, and this wouldn't exist. Okay, so this will never happen. But I just want you to understand that if G is bigger than I, that you should go for that. All right, it's going to be a huge opportunity if somebody offered you that. Don't just say it's 0 or you can't do it because you don't have the formula. It will be huge, right? So these values would just, it would explode. You'd get more, these numbers would go higher. It wouldn't go down. They would go up over time. Anyway, think about it. You'll believe me one day. I'm not going to write it all out because I don't want to spend time on that, but it won't erode. Okay, so there it is. We have those simplifications known as perpetuity, and this one is called a perpetuity with growth. There are no special keys in the calculator to compute these amounts for perpetual cash flows. You just have to use the formulas. If you have a stream of cash flows that don't meet the criteria that I described, then you should go back to using mixed cash flows approach and basic time value of money, discounting each one of them back. So there's no fast way to do it. If you have, for instance, infinite cash flows and all the numbers varied, you couldn't use these formulas. That's why we make these simplifying assumptions, so that we can actually use the formulas and get a number. You know, these results are only as good as the assumptions. Okay, so now we've moved on to something that's related, but not a perpetuity. What if, we're going to talk about a loan right now. So what's a loan? You're going to borrow money. You're going to borrow money and then you have to pay it back. $100 for the next 4 years, but every month. These are monthly payments. And I tell you, the effective monthly rate is 1%. So with that information, what did you borrow? Here's the timeline, $100 a month, and because there's 12 months in a year, it's a total of 48. So this is the 48th month here, and that's the timeline for 48 months. Now, you really don't want to put this in NPV for 48 payments. I mean, you could do that, but there's got to be a better way, right? Because these are all the same, and there's only 48 months. It's not a perpetuity. This is not a perpetuity because it stops. However, it looks like a perpetuity, right? Because they're the same. So let's take advantage of the perpetuity formula and say, somebody's asking a question. It's the most you would be willing to pay. Yes, Ariette. That's a little more meaningful than break even, but anyway, if you understand it that way. It's the most you'd be willing to pay for that investment. The break even. Okay, so it's not a perpetuity, but we can take advantage of the perpetuity formula in this way. So here is a perpetuity here, right? Same cash flow forever, first one period from today, and I keep on writing C1 because they're all the same. But it's not a perpetuity because I don't get any cash flows after. So what I'm going to do is use the perpetuity formula, and then I'm going to subtract the value of the cash flows after. What's the value of the cash flows after? So here's the timeline for the cash flows later in the future, but because it's in the future, I need to discount it. The cash flows in the futures will total this amount, but at time t. I need to discount that amount, so it's basically the perpetuity formula again. I need to discount it back though to time 0, so I put a discount factor here. So I put a discount factor there. So subtracting those from each other I have this formula. This is the perpetuity formula with adjustment for the fact that I am not going to get a perpetuity of cash flows. I'm going to get only T. So this is the adjustment factor. So you're going to be able to use your formula, but that's why there's a negative here, right? Because it gets smaller than getting all of them. You're not going to get C1 forever. You're going to get less. You're going to take away the cash flows that occur later. So this is called a special name. This is an annuity, which you should be familiar with, but if you're not, here you go. And the technique I used to derive the formula is a technique that you should learn. You should get good at using that technique. However, I'm not going to test you on this exact problem, but you should be able to follow what I just described. Does anybody have any questions about what I just did? Let's look at that for a minute. Okay, so just repeating one more time. This is a perpetuity with these cash flows removed, the later ones after T. So I virtually do that. I take off the value of the future cash flows. To do that, the future cash flows are also a perpetuity, but at time T, one period before the first one. And I need to discount that back T periods, and then this amount needs to be subtracted from the whole perpetuity. And that gives me mathematically, when I collect my terms collected are this one and this one, so it leaves a negative in here because I need to take away some of the cash flows. All right, so let's use the formula now. Now this formula is programmed into your calculator, and in fact we're going back to the TVM keys to enter it. As long as your timeline is like level cash flows for a set period of time, you can use this formula rather than using the NPV formula and entering those cash flows 48 times into your calculator. Just a few things to point out. The payments here were monthly, so that's why we needed a monthly rate. Okay, these formulas only work when the timing of payments matches the compounding of interest, the rate of compounding of interest. So let's enter this into our calculator. We're going to use the TVM keys, so you might want to clear them, or you don't have to worry too much because we're going to enter from left to right all of these values. First 48 periods, then 1% interest rate, leave PV empty because that's what we want to find. Notice now we're going to use the payment key. So everyone was asking, what is PMT? That's what it is. It's for the payments of an annuity. So if you have a problem with payments in it, you know you're using an annuity. You put negative 100 because you have to pay it back, right? You're paying back the loan. And then you tell the calculator you're not interested in the future value, just put 0 in there. And then compute PV. And so the answer is you borrowed $3,797.40 to get this deal. You will be paying back $100 for 48 months. Any questions? Again, for the test situation, I want this formula and this answer. You don't have to show me the intermediate steps. This one will give you 0 points if you write that down. But you might want to, like some students like to write their steps. That's fine, but you're not going to get any points for it. Yeah. the timeline, you should draw me the timeline, okay? For payment problems, I like to see the timeline. You can use the ellipsis here, the 3 dots, so you don't have to write out too much. You actually don't have to write all of this. You just need to put this one, the ellipsis, and this. I think it's called ellipses. Okay. Yes, your calculator must be in end mode. I guess, I don't know, we left off with it, beginning mode. Yeah, your calculator must be in end mode. All these payments are assumed end of period. The next problem will be different. Yes, end mode. Oh yeah, don't worry. We're gonna do inflation. All in good time. Okay, so we've gone through half of the notes and we have 1 hour left. Let's see how much we can get through. Okay, so here is the next problem. Okay, wait, did you all get it? Can you guys tell me you got the right answer? Tell me, a few people. How many people got the right answer? Okay. Yeah, you repeat the functions to get off. Thank you, Jennifer. Jennifer's my assistant. She's doing a good job answering my questions. Second begin, second set. Yeah, you got to put it back. Okay, you got it? Yeah, it should be exactly the same, Ricardo. Okay, let's see if like 5 or 6 people tell me they got it, I can continue. 25 people in the chat, very good. Anybody else get the answer? Okay, very good. Good. Okay, a couple more people. So we're now using time value of money for the time value of money keys for time value of money problems and annuities. Okay, that's what we've done so far. Right, the begin. You got to be careful about that. Make sure it's off of begin mode. Okay, one more. See if one more person. So the real thing is you need to know how to put the values into the formula, right? Remember, this is C1. This is the discount rate, interest rate, return, rate of return, whatever it's called in the problem. Interest rate, borrowing rate, all these different terms for the same thing. They're always on the bottom. I is always on the bottom. Okay, I'm going to continue. All right, I'm going to jump over those derivations and let's do this here, and then I'll go back to talk about that. So page 49, slide 49. So this is an annuity as well. However, I'm going to call this an annuity due, and you're going to see why. You sign a 5-year lease to rent your office space to a dentist. So you're going to rent it to a dentist for $1,200 per month to be received at the beginning of every, so I've underlined it here, but I'm not necessarily going to do that on test, right? So you have to read carefully. They're to be received at the beginning of every month for 5 years. The effective monthly interest you agreed to is 1%. Okay, so the payments are monthly, and the rate is a monthly rate, so everything's good. This is the timeline, and because it's 60 payments and the first one starts now, it only goes till 59. So drawing the timeline helps drive the point home that the formula is going to be slightly different. We have to modify the formula for this case. All the same payments, 59 periods. We don't want to use NPV because that's going to take us forever, so we're going to use an annuity. The formula needs to be adjusted because the annuity is starting now, not one period from now, okay? So this is the adjustment I'm going to give you. Here's the annuity for the cash flow starting one period from now, and this is the one now. To adjust the formula, I have to add that one now, and I have to reduce the number of payments by 1. So this is the annuity due formula. It's one version. There's actually 2 ways of writing this. Okay, so that goes along with that timeline. So, to put this in your calculator, or on a test situation, I want you to write this, and then enter it. You know, if you enter it into your calculator, you have to remember that there's 2 parts, and you have to enter 59 periods. So method 1, there's actually 3 ways of doing this. Method 1 is to use 59 annuity payments of $1,200, and at the end, when you get your answer, probably should have made this a negative and then that's a positive. But anyway, once you get your answer, you add the answer to the first payment of $1,200. So try and do that. You should probably make this a negative so this can be a positive. I'll change my notes. Well, actually, no, you know what? I left it like that because I'm receiving, right? So yeah, I'll leave it like that as a, just have to make the adjustment after, because you're receiving 1,200 in this storyline. So try that, and then we're going to talk. No comments? You guys got it? Let me know you got it so I can continue. Okay. Okay, so yes, so Von Mighty said, what's the big deal? Just leave it in begin mode and use 60, and that's another method, okay? So you could do it this way that I've shown, first of all, because that is the way we wrote the formula. The method works with the formula, okay? The second method is to use begin, so put your calculator in begin, and then enter all the values. Just as though it was a regular problem, annuity problem, the calculator will make the adjustment for you. It will do this. Once you know it knows begin, it will use this formula instead. It will minus the 1, for you. So the result will be this, which you interpret as an opportunity cost. Like basically what you're saying is, well, this is what it's worth to lease the apartment or the office, and so that's what it's worth to me. If somebody came to you and said, do you want to sell the office? And you think about it and you say, well, I can make off this much this year, and then for the next however many years, I could have made this money. It's an opportunity cost. So that's what you can think in valuing the property. So this is method 2, just use begin mode and 60 payments. Everything else is like as though it was a normal annuity, a regular annuity. Just going back here a bit, just making sure people got it, right? Because this one, you have to make it a positive and then add. So if you don't do that, you're going to get the wrong answer. All right, so there's method 1, method 2 with the begin mode, which now turn it back to end mode to avoid making mistakes with the other problems coming. The third way comes from realizing remembering each cash flow has two perspectives. It's both the beginning of something and the end of something, right? So it's at time 0 here. Time 0 is the end of the year before, or in this case, the month before. So remembering our formula require, the formulas give you the value 1 period before the first payment. You need to remember that. In this case, if the first payment is at time 0, then the value, if I use the formula as it is, would be at time -1. So if you were to just use the formula, if you were just to put this in your calculator as normal in regular end mode, the value you're getting out of your calculator would be here. So the adjustment would be to move it 1 period ahead. So that's what this is. This is the regular annuity formula accumulated 1 period to take you back or take you forward to time 0. That's the third method. They all should give you the same answer. So now try that. Let me know how you did. So to repeat, if you enter this as usual, what you're getting is the value at time 1 period before. That's all the -1 means. 1 period ago. So what you have to do is adjust it with 1 period of accumulation. So this is the third approach. Third is, well, I guess it's the second variation on the formula. So when I give you a problem on annuity due, you have to write this formula or the other one, and then give me your answer, and that's it. So you write this, and the answer, and the timeline for payments. You don't have to know the 3 methods by name, you just have to know the techniques. You guys getting it? Okay, we have about half an hour left. I'm sure that we'll finish these notes. Oops, sorry. So sensitive. Okay. Bonds. I'm moving to bonds. Any questions? Everybody got it? I have all this derivation here, but it's the same thing as I did before. For annuity due, to derive the annuity formula, it's just 2 perpetuities. It's saying I'm going to get the same cash flow for only T-1 periods plus the one today, but not these ones over here. So I got to take those off. I'm going to subtract a perpetuity later, but that needs to be discounted back. The only catch is this formula. So this looks a little confusing, but everything is adjusted for one period. I subtract those two and I get this formula here. So have a look at that. Again, I'm not going to ask you to prove that, but it's really good to be able to use that technique for solving problems for yourselves, because there's going to be problems like that. Okay, you guys are quiet. I will continue. Assuming that's a good thing. Okay, bonds. So to this point, we've used our calculators, but notice we always enter 0 into one of the keys. Like we don't use one of the keys, future value or present value. That's going to change with bonds. First of all, in this case, it won't, but then when we use coupon bonds, it will. Okay, so here's a bond problem. A bond pays $1,000, so that's called the face value of the bond. Look familiar? Right, so it pays $1,000 in 5 years. That's the maturity. The time to maturity is 5 years. If bonds of comparable risk have a yield to maturity, remember I told you this is just like the interest rate, 6%. What is the fair price of the bond? All right, so that's it. That's the picture. Look familiar? This is a basic time value of money problem for a 0 coupon bond. We'll talk about coupons in a second. There's a basic value of money formula, discounting 5 periods of 6%. Using the time value of money keys, you can enter it. And so it's a basic time value of money problem, and this is interpreted as the fair price, or the most you'd be willing to pay. Actually, it should be a positive, but that's the answer. So the price would be $747.26. It's a negative because of what you would pay, but I want to see the answer as a dollar amount. Okay? Now I want to talk about coupon bonds. Now coupon bonds are different because, well, here's a timeline. So different because I'm going to get an amount throughout time all the way to the end of the bond's term. And at the end I'm also going to get the 1,000. So what we're going to have here are, in terms of our formula, we're going to have two formula. We're going to have the annuity part, and we're going to have the time value of money part. So basically we put both of those formula together to make a new one. Okay, so that's the idea. These are the formulas on the formula sheet are the basic formulas that I'm going to give you, and you can use those to solve all of the problems, either combining them or adjusting them in some way to suit the problem. To be able to do that, though, you need to know very well what the conditions are to use the formulas. So you've seen this before. How do I determine the coupon amount? So that's what the $60 are, right? These are the coupons. So I got that from this. To find the payment, or the coupon, I take the face value times the rate. This is the C here. And notice in the problem, I didn't say anything about the face value. You always assume the face value is $1,000 because in reality it's always $1,000 or $5,000 in real life. Okay, for bonds. So the face value is 1,000. I'm having trouble with. That's better. So in this problem, let's enter it. Okay, we have figured out the payments we get. This is the PMT. This is the, oh yeah, it does have the face value. Sorry, I don't know why I didn't see that. That's the face value. This is the T for the formula, or the N. And this, we just used it to make this calculation for the payment, okay? And then this is the I by Y. So we have all of the variables. We have all the values for the variables. So entering this into our calculator here, we get this answer. So let's see if you can do that and let me know you got it. Notice I used all of the keys this time. No zeros. Okay, so yes. So you guys notice that the price is the same as the face value. What's happening? So it says you got to pay $1,000 now to get $1,000 later. That sounds weird, but it isn't weird because you are getting the 6%. You see, you're promised a yield of 6%, and you're getting it through the coupons. You're getting the 6% every period as $60 coupons, every period right to the end. So when the coupon rate matches with the yield to maturity, the annual yield to maturity, you're getting your interest over time, not at the end. So we call this kind of a bond a par value bond because they are the same. Okay, so you just get your principal amount, you get the money that you loan back at the end, but over time you get the 6% a year. So what happens when they are not the same? So I start with that case, and what happens when they're not the same? So here in this problem, it's going to be less. So it's less. It's 30, 30, 30 with the same yield. So what should we expect in the price? Should the price be higher or lower than 1,000? So some people have said lower, and they're right, right? Because look, it promises to give me 1,000, but it's not giving me the full 6% in coupons. So I got to get it some way, right? I got to get it some way. So instead they give me a discount. That's why we call a bond a discount bond if the coupon rate is smaller than the interest rate. So this is the formula with the values entered, right? This is the payment. The I is always on the bottom, yield to maturity, and this is the face value here. So when you enter that, you will see it's lower than 1,000. So try that. So to compensate you for not getting the 6% through the coupons, you got to get a discount. That's why it's lower than $1,000. Let me know you got it. Okay, what about the next one? What if you're getting at the same rate of yield to maturity? Yield to maturity is 6%, but the coupon rate is higher. So now you're going to get 70 every period. End of every period plus the 1,000 at the end. Get your money back. So now what's going to happen? What should the price be? Higher or lower than 1,000? Since you're getting more than the yield, you have to pay extra for that. So that's why we say when the coupon is higher than the interest rate or the yield to maturity, you are buying a premium bond and the price will be higher than 1,000. All right? So make sure you punch that in and get that. So make sure you, from left to right, okay, N is 5, interest is 6, PV is what we want, so we leave it empty, 70 into payments, 1,000 into future value, and then of course we'd have to pay $1,042.12 today, so that's a negative, to get those future cash flows. All right, I think you guys get it. So the best way to get this is to keep track of the timeline, right? Remember the timeline. So this was an annuity plus a basic time value of money expression. Same formulas, we didn't learn anything new. If you were asked to punch this into your calculator by hand, manually, you would enter this part and I would say store this part and then enter this part and store it in a second storage, and then add the storage amounts together. But I'm not going to ask you to do that. But if you didn't have your finance calculator with you, that's how you would do it. Okay, I'm going to continue. So now the real reason why we're using the finance calculator, because really all the rest is doable with a regular calculator, the real reason is to solve problems like this. Find the interest rate now. So we have several variables in these formula, and I usually give you all of them and ask you to figure out one. In this case, I'm going to ask you for the interest rate. I'm going to tell you the price. So this is a discount bond. I'm going to tell you the terms of the bond. 3%, in other words, $30 at the end of every year for 5 years. So you get this amount and this amount at the 5th year. So, but I want you to figure out what the yield to maturity is. It's a discount bond, so that means that the coupon rate, right, is smaller than the interest rate. So it's going to be less than, it'll be bigger than 3%. I know that because this is smaller than 1,000. So I know the coupons are not enough to meet the interest rate. So the interest rate has to be bigger. But I don't know what it is exactly. If you look at this formula here, and I told you to isolate I, can you do it? Can you analytically solve for I? You won't be able to isolate I on one side and everything else on the other because I appears in two expressions. So you could do computer estimation. I think in your textbook and earlier courses you probably used some interpolation a technique to calculate this. But the calculator that you're using right now will do it for you. It's programmed in your calculator and it does the iterations for you to figure out what I is. You just have to enter the values properly. So to do that, n is 5. So 5 into n. Interest is what we want, so we don't put anything. The price that we would pay is negative. Cash outflow $854.55 to get $30 and $1,000 later. So these are positives. And then ask, compute interest, and you'll get this answer. It's that easy. So I would never ask you to isolate I and solve it. Oh, sorry, and then you also have this I over here, right? It's impossible. To isolate I, you would have to pick a variety of I's and interpolate towards the right I that solves that problem. The calculator will do that for you instantly. It also solved for T, the duration or the term of the bond. Oh, and C as well. So can I go on? Can I continue? Everyone gets I? Okay, I'm going to go by what Tiana says. So you got it? Oops, this keeps on happening. All right, so let's do the next one. Let's find the coupon rate. So this bond sells for $900. So it's this is also a discount bond, right? where the yield is 8%. So we know that C must not be as high as I. Because it's less than $1,000. It's a 5-year bond. To solve for the coupon rate, we have to do a couple of steps. We can only, first out of the formula we'll get the payment, and then we have to convert it to get the coupon rate. So here are the values. Here's the formula that you need for your test. Then n into 5 into n, the interest rate is 8, the price you pay is $900, put $1,000 face value, and then compute this amount. This is a payment, but we need to know what is the rate. Remember, the payment is derived from this formula, so we just solve this formula to find the rate. So basically, rather than multiplying 1,000 by the rate, we're going to divide the dollar amount to find by 1,000 to find the percentage. So in other words, the payment divided by the face value to get the coupon rate. And as we discussed, C is less than I. I was 8% and C is less. It's 5.495. So everybody's got that? Okay, next. Okay, so we're on to a new formula. The last formula on the formula sheet that I gave you. Annuity with growth. Here's the timeline for this story. Angel can purchase an annuity to receive 30 years of supplemental pension payments beginning next month. So 30 times 12 is 360 payments to be received. But you're told that he's going to get 100, but then he's going to get them. Where is the 100? I didn't even mention the 100. So the first one's 100, and then to adjust for inflation and over the month, a 0.2% growth rate of the payments is used. So it's 2.2 every month. So that's the growth rate of the payments. Meanwhile, there's a monthly interest rate of 0.5%. And the way you think about that is these payments are earning, so this fund that's paying the pension is earning a 0.5% per month, while you're receiving, or the recipient is getting $100 with growth of 0.2% per month. All right, so with these cash flows, what is the present value? We know time value of money applies. We need to take all these things into consideration. We have an annuity formula, but this is slightly different. This is more like the growing perpetuity. So let's see. Here's the growing perpetuity formula, but now we have to take off these cash flows. These cash flows as a total are a growing perpetuity as well, but the first cash flow is different than C1, so that goes here. Remember, for growing perpetuity, it's C1 over I minus G, right? So these cash flows make a perpetuity of C1 over I minus G, and I have to minus off the discounted amount for the cash flows I don't get. The cash flows I don't get are also a perpetuity, but a growing perpetuity that I can value here at time t. So discounting that and then putting it in time 0, I just take the first amount, which is a perpetuity, growing perpetuity, at time 0, and I subtract this one, that's an adjusted growing perpetuity. All right, so all of that, again, I want you to learn those techniques. When you do the algebra, you collect your terms. This is a common term to both of them. And this is the result. A growing perpetuity with an adjustment. This is your adjustment factor. It looks like the other one for the regular perpetuity. But you adjust it. Notice the I is at the bottom, right? It's a growing perpetuity. So the G that grows the payments is on the top. This formula only works if I does not equal G. Why? Because if I equals G, this will become 0. So that would make the whole thing a 0 on the bottom, and we know that doesn't exist, or that's indeterminate for a fraction. Another reason is that this whole thing here will become 1, and then 1 to the t will be 1. The whole term inside here would become 0 because it would be 1 minus 1. So you would have 0 divided by 0, which again is indeterminate. Doesn't make any sense. So this formula only works if I is not equal to G. There is no formula programmed in your calculator. You actually have to enter this. So let's practice that as one of the last things we do today. Let's practice entering this into our calculator. So where I would start is the more complex thing deep inside the brackets is start here. Well, I could actually start here where I simplify this amount, so I don't punch that in and make it more complicated in my calculator. So I would simplify that and start here. So I would take 1.02002 divided by 1.005 equal, and then use y to the x, 360, and then equals again. Okay, that will give me that part. So once you have that, let me know, and I'm going to continue. Once you have that, I'm going to stay inside, and I'm going to press this key to make this a negative, and then I'm going to add 1 and say equals. By doing that, I will have this entire bracket. And it's going to be very easy to multiply by 100 and then divide by 0.003 to get the answer, $21,000. So try and follow my steps. That's the technique I use, and I perfected it, and you should too. I gave you exercises to review for this week. Well, I gave them last week if people wanted to work ahead. And they were on annuities, and on inflation. And essentially, I'm asking you to, it's all annuities. You have to use the annuity formulas. So work on those this week. I'm going to finish this problem, but work on those problems as annuities, not using NPV, all right? You still need to know NPV, but I really want you to be experts with annuities. So you guys getting this? Are we good? Using my technique. Don't use your TI-84 calculator with the long formula, please. Use this technique, because I'm especially, in a regular class, I expect students to be able to do this. I'm just squaring off the keys. Okay. Well, I gave you one called discounting and inflation, and the other one called review, and another one called annuities. I gave you 3, I think. So 1.2, 1.4, and 1.6. So work on them, and then next week your reward will be, I will give you the clave for those, and then we can talk about if you still have problems. Okay, so try and complete them yourselves, and if you don't get it all right, that's okay, because you're going to learn something. So let's finish this one up, and then I'm going to let you go. So this is basically the growing annuity formula, and I ask you what happens if I equals G. Well, if I equals G, it doesn't mean that this doesn't exist. It just is that you do not use the formula. You have to do it a different way. It doesn't mean that the answer is 0 or the answer is infinity or the answer does not exist. You just can't use the formula. No, the answer exists. You just can't use the formula. So here's an example. You are considering a deal where you will receive $100 for 4 months starting next month, and each month thereafter, cash flows will grow by 1%. What would you be willing to pay for such a deal? So here's the timeline. That 77 is just the page number. Now here's the timeline, and we're told since I equals G, I cannot use the growing annuity formula. So what do? Well, I go back to first principles. I discount. So the first one becomes that. What does the second one become? And this will help you understand the other exercises with perpetuities. So this one will become oops. All right, but then what's going to happen? Well, this will cancel with one of these, and I'm going to be left with the same thing I had above. Not easy, my dears. Oh, okay. All right, so that looks the same as the one up here. And is that going to happen all the way down? Yes, it is. I'll just show you the next one. So there's going to be, this one will be 100 with 1.01 squared, but the bottom is 100. Sorry, the bottom is 1.01 cubed. Again, two of these will cancel with two of these, and it will leave one, which is the same as the other two. So there is an answer. And because there's 4 periods, the answer to this is going to be 4 of these. So there is a formula, but it's not the growing annuity formula. It's going to be 4 times the first one. And you can put this formula on your formula sheet if you want. Just you have to know, you have to put it with the timeline, so that you know that those are the conditions for that formula. Those are the assumptions of that formula. Okay, so I've gone over a bit. I'm going to stop here. The last, I'll do the pension problem when we get back. But for now, work with the 4 documents or 3 documents I gave you and solve all of those problems for yourselves, so that when we meet next week, you can have a ton of questions for me, or none, because you've resolved them all yourselves, okay? So work on preparing those, prepare them as though you were handing them in, but I'm not going to look at them. It's just for you, all right? And I will send you the new set of notes, because we're going to now, the next thing we're going to do is interest rate conversions. So until now, all the rates I've been giving you have been effective rates. So I'm going to change that and make the problems much more realistic. All right, so you guys can go. Anyone who wants to stay, I'm going to stay back. If you have questions, you can ask me in the chat. Otherwise, you guys have a great week. You can always email me, and I think, I don't know if I put a Connect assignment up yet, but I will soon. All right? Okay, bye for now. But I'll stay on. If somebody has questions, they can ask. Oh, someone wanted to know about a TA. Well, I have a TA, but I really don't think you need the TA right now. Like, if you really need the TA right now, I don't know. I think you have lots of time. If you need a TA, let's talk about it next week, for a TA next week. But right now I have my TA doing something else I need him to work on. I'm going to check with him if he'd be willing to meet with you. But I don't see... I think you should use this time to determine what exactly you need help with, because for the TA to take time to just go through all the notes again, I mean, you need to sit and go through the notes, okay? And then next week, if you're still having trouble, I think it's going to get complicated next week. I think right now you have what you need. So on Thursday, or maybe even Wednesday, I'll send you the solutions so you can check your work against the solutions, and then on Friday we can have a good conversation. And if you really think you need some help, probably next week I'll set that up. Okay, so I'll teach him how to use YouTube, or maybe he's good and proficient with another platform. I'll find out. Okay, but I have him doing something else right now. Have a good day, everybody. Okay. I really think you should use the resources that give you to the maximum, and if you still need some help, focus that help on that little extra piece. But to have a TA go through all of this again is just not, it's not fair to the TA, or you need to spend time alone working with this material so you can formulate your questions. When you have good questions, that's when you can really learn. I just gave an inflation example, and I gave you exercises with inflation. Von Mighty. So work on the exercises. Work on the exercises, and then we'll talk on Friday, and I'll go through them in detail. It's not a test, it's just an assignment, right? So do some research if you need to. Yes, inflation is related to growth, exactly. The inflation rate will be the growth rate in the first part, in question 1. What you need to do that, what is the relationship between inflation that's nominal and, when you have real interest rate and nominal interest rate, what is the relationship? It's known as the Fisher relationship. I don't know if I spelled that wrong. 1 plus the nominal rate, I use R nominal, times 1 plus inflation, no, I'm doing that wrong again. 1 plus R real times 1 plus inflation is equal to 1 plus nominal. Anyway, I want you guys to do the research for that yourselves. I'm going to write it. I'm going to erase it. That's what you need to know. Look up the Fisher relationship. I want you to do some looking back. These are like review. Most of the stuff that we're doing is review. The only new thing is this annuity formula. So look it up. Then you'll appreciate the answer. Oh, Juan is asking. So the nominal is what? So all of the rates that we've talked about so far are considered nominal rates. Okay? The real rate is always with related to I don't want to tell you. I want you guys to do this because now I'm going to give you a lesson on real nominal rates. Look it up. It's in your book. Okay? And we'll talk about it. when I do a formal introduction, but it is the Fisher relationship that you want to use to solve that. But the rates that you've been using so far are all nominal. Nominal rates of interest or nominal rates of return, they're all nominal. And all the dollars we've talked about so far have also been known as nominal. Okay, so the idea, the new concept, a relatively new concept, would be the real part of it. So do your best with that, and then we'll talk about it in depth on next week. Okay, it's noon. Have a good lunch and be in touch over the week. Take care.